All right. Hello traders and welcome out to our next video course, establishing some trading foundations. And this one is all about options. If you liked our first course on placing your first stock trade, you're going to love this one on placing your first options trade. We've been talking about this. We've been building up to it. Here it is. We're ready to get started. If we haven't met yet, my name is Scott Beck. I'm the head trader here at MarketWatch Group. Hopefully we've already met and talked and interacted either in one of the channels or in the live meetings. If not, I hope you start attending them soon. However, this course, like the one for options, is very special, very particular, and it's oriented all around beginners. So if you already know and understand options pretty well, you're going to find this is a repeat. It's a good repeat. You probably want to make sure that you have these principles and these foundations in place. The way that we're going to use an options pricing model, really build and understand a trade before we get into it. If you've never done that before, I still think you're going to get a lot from this. But we're going to take an options trade, we're going to break it down into every little step, one at a time, and make sure that you know what you're doing and you're comfortable with it. And even then, my advice to you is make sure you paper trade first. Don't go live. Don't put skin in the game before it's necessary. Get acquainted with the options market, with the platform that you're trading on. Get a few trades under your belt and then start trading live. So let's get started with this first session. Like always, with every presentation, with every video, I need to talk about our disclaimers. I need to remind you that this is for education and illustrative purposes only. We are not brokers, we are not advisors, and we don't give advice and we don't give recommendations. With that in mind, what are we going to do? Today is all about an intro, understanding the basics, which are what? Calls and puts. And because we're building our first trade in this circumstance, it's going to be a call. There are other trades we could build, but we're starting with the first, most basic, most simplest strategy. And that's the one that you're going to see happening most of the time in a bullish market. We want to make sure you understand the difference between options and stocks. We want to make sure that you understand a few of the essential terminologies: strike price, expiration date, premium, things along those lines. If you haven't done it, I want to just walk through the steps to an options agreement with your broker. That's the form you have to fill out, an online form, where you acknowledge your education level, where you acknowledge your income level, your understanding of options, and a few other questions. And based on that, they're going to give you, or not, the approval to trade options. If you're going to buy calls, you need at least a level 2. Level 1 is covered calls. If you own stock and you ask for it, they'll give you that. But we want to make sure you understand what they're going to ask you so that you don't find yourself getting denied and then unable to trade for 90 days or more. Lastly, we want to make sure that you understand the risk in options trading and have a good sense of the overall option market structure. So that's what we're going to do here. Each of these is going to be about 15 minutes long. So we're going to try to get through this pretty quickly, get you oriented, get into a platform, start building the trade so that you can start replicating that, practicing it on your own. With that in mind, let's get started. Okay, let's get right into the meat of it. What are we doing here? Introduction to options. We want to understand calls and puts. So let's start there. Here I have the Thinkorswim platform. I am in the Analyze page. We're going to be in here a lot over the next 8 videos. But in here, we have the ability to see, first of all, we're going to be looking at VSCO. That's the underlying stock. And here I have stock information. Then next step down, I have calls on the left, puts on the right, expiration down the middle, strike prices down the middle. Those are all going to be very important for you to understand. What is a call? A call gives me the right to buy something, which would be beneficial to me if I think it's going up. That is a bullish strategy. Puts give me the right to sell something, which is beneficial to me if I think it's going down. I lock in a selling price. That's it. If I'm bullish, I think the stock's going up, I use calls. If I'm bearish, I think the stock is going down, I use puts. So what's the key difference between stocks and options? Well, the stock, you're buying shares. I'm buying a piece of the company. For $48.71, I can buy one share of VSCO. For $4,871, I can buy 100 shares of VSCO. That's it. It's one for one. That's buying a stock. Okay, so then what is it when it comes to options? Contracts. I'm buying a contract. Each one contract controls 100 shares. Now, we're going to talk about a couple of things. We're going to talk about in the money, at the money, out of the money. Let's go at the money first. This stock is at $48.71. What is the closest strike price to the current price? Closest to $48.71 is $49. That's my at the money strike, at the money. Now, if I'm looking at calls, which I am, and that's what we're going to be looking at today, we're thinking about in the money versus out of the money. Now, at the money's closest. What does in the money mean? In the money means it has intrinsic value. The option itself has value. So let's go to this round number one that this is in the money. I have the right to buy VSCO, in this case for $45 a share. Is that beneficial? Well, yeah, I can sell it for $48.71. Buy it for $45, sell it for $48.71. That's great. $3.71 of profit? No, that's not profit. That's intrinsic value. That's the difference between the strike price and the stock price. I have to pay $5.40 to get that $3.71. What's the extra money for? Time. Time value. Now, if I go out here, this is out of the money. I have a $60 strike price. How much intrinsic value does that have? Well, if the stock is $48.71, I can buy it for $60. I don't want to buy it for $60. If it's at $48.71, I could just go buy it from the open market for $48.71. That has no intrinsic value. Therefore, it is out of the money. Out the money. Which means that this price, there is no intrinsic, so it's all time value. Now, let's stop for a second and let's look at this column here. If you're looking at puts, it's this column here, the ask price. Now, this is per contract. A contract controls 100 shares. So when I look at this price, it's not $5.40 per contract. It's $5.40 times 100. That's $540 per contract. But remember, 100 shares of the stock was going to cost me $4,871. So $540 to control 100 shares. What have I just done? I've just utilized leverage. Right? So that's what I'm trying to do with options, is I'm trying to control the stock with less capital. I don't have to put as much money up front. So we have a couple of things: calls, puts, right? We have in the money, at the money, out of the money. Now it's completely opposite. This is for calls. If I started looking at puts, it would flip upside down. What else is important to us? Expiration. These expire January 17th. That's the third Friday of January. Technically, they expire the third Saturday at midnight, but they stop trading the third Friday at 4 p.m. So for all intents and purposes, that becomes the end of when we have the ability to trade the option, and that is its expiration. Funny things can happen in that time from 4 o'clock until midnight the next day. So you have to be careful. Better not to just let options sit out there. But that's the expiration. Now, we have standard expirations are third Friday. So if I say the Februaries, that means the third Friday of February. If I say the March, that's the third Friday of March, unless I denote weeklies. Now, this one doesn't have weeklies. But just to quickly get a sense of what you would see, let me come here to the SPY, and you can see all these purple are weeklies. This one has a lot more. Why? Well, because it trades a lot. One of the things we're going to get to later on in this course is liquidity. This Victoria's Secret is not very liquid, but it's liquid enough. So we'll talk about that. What else do we have? We have the premium. That's the cost. That is this ask price times 100. The premium for one contract of the 45 calls is $540 to buy the 45 strike of the January 17 expiration. So that's just a few pieces of terminology. You want to understand an options chain. Over here on the left side, you can see I've got December's with only 5 days left, January's with 33. I come down here to the March and there's 96 days. That helps you understand time. Now, remember that in order to be able to trade options, you need to have an option agreement on file. So you need to work with your broker, and if you haven't, fill out the option agreement. If they're going to ask you, how many years have you traded options? How much do you understand options? How aggressive are you? That you have to be careful. I'm going to warn you. That is cover your butt documentation for them. They don't want you to be like, hey, I didn't know what I was doing. You shouldn't have let me trade options. And then they sue you. That's happened. So they're having you come in and say, yes, I understand what I'm doing. I'm smart. I'm savvy. I have money. I have experience. And if you do that, they'll give you options. If you come in and you say, I don't have any experience, I don't have much knowledge, they're going to be like, yeah, no, you're not approved. I warn people of this. Then they do it and they're like, I didn't get approved. Okay. I'm not going to tell you to say anything you're not comfortable saying, but just understand what they're looking for. They're looking for you to say, you know what you're doing, you're aggressive, your time frame is long, et cetera, et cetera. So we might even want to have a chat channel about this on the site where people can talk about things that they've answered. Next thing, the importance of understanding risk in options trading. Everything is 100% at risk. If I buy this contract right here and I pay $540, I could lose all $540, right? It's less. It's not $4,871. I'm getting 9-to-1 leverage, but I could lose all of it, 100%. If the stock drops precipitously, I could easily drop. You could lose 100%. So leverage cuts both ways. That's an important thing for you to understand as far as the risk goes in options trading. Lastly, the options market structure. So again, this stock is a little less liquid, right? And so it only has monthlies. So I have monthlies here, I have monthlies here, but I do have strike prices at every dollar increment. That's something that you'll find yourself looking for and paying attention to. What are the expirations? Do they have weeklies? If so, that's favorable to us. We definitely prefer stocks that have weeklies. This one doesn't, but it's still right on the verge. And you'll see later on in this video series why I say that. We want to be paying attention to strikes. Do they have dollar increments? 1, 2, 3, 4, 5? Or do they have $5 increments where it goes 45, 50, 55? Those are some of the dynamics that you're going to see. Keep in mind, there are over 3,000 companies that trade options. Only about 400 of them have really what we're looking for by way of liquidity, the tightness of the spread. This is something we're going to talk about. But hopefully this just gets you a little bit more comfortable with a few of these terminologies. Remember that this video series is oriented around buying. We're going to buy a call I'm going to give you a little sneak preview. This is where I think we're going to end up, but we'll see when we get there. All right, guys. Well, that's going to do it for this first video. We'll transition and go from there. All right. And that's going to take us to the end of this first session. Hopefully you have a little better idea now of the basics. A few terminologies you maybe didn't understand before. A little clearer about what calls and puts are and what are our intentions with them, what we're going to try to do. Now what? Well, we've got 7 more, but we don't want you thinking about the next 7. I just want you thinking about the next video. With that in mind, think about the next video in this series, choosing an option strategy. We're going to talk about the other strategies so you understand them, but we know exactly what strategy we're going to use for the trade that we build in this series. The easiest, which remember, buying a call. We're in a bullish market. That's the best market to trade. It's the simplest, easiest strategy to get in and get out. That's the one we're going to use. But I want to make sure you understand what else is out there. Open your eyes so you understand there is more for you to learn once you get these basics in your repertoire. Okay, what else? Make sure that you have that option agreement completed with your broker. Make sure that you have really familiarized yourself with the basic terms and concepts that we've covered in this session today. Because as I'm going through and building trades, as you're seeing trade alerts coming out, you're going to want to make sure that you understand quickly and easily what it is that I'm talking about. Make sure that you understand the options section of your trading platform. If you are a Thinkorswim trader, you're going to understand it because you saw it with mine. But if you're somewhere else, Interactive Brokers, if you're with TC2000, any of these other platforms that exist, they have similar areas for options where you can understand the analytics. Make sure that you go familiarize yourself with it before you start trading live. Lastly, as always, make sure that you join the Market Watch Group Circle community, discuss your learning journey, ask questions, participate. The coaches are there to help. The other traders are there to help. Join us, get in there, make sure you do that. With that in mind, we're going to move on. Make sure you get to the next video, choosing an option strategy. And as always, happy trading.